Today, we'll be finishing up Chapter 17, discussing the last method of depreciation. We will be covering 17-4, Modified Accelerated Cost Recovery System, called MACRS, with a little bit of discussion of ACRS, ACRS. In Learning Units 17.1 through 17.3, we discussed depreciation methods that are used for financial reporting. We discussed the straight line method, the units of production method, and the double declining or declining balance method. Since 1981, federal tax laws have been passed that state how depreciation must be taken for income tax purposes. Assets that have been put into service from 1981 through 1986 fell under the Federal Accelerated Cost Recovery System, or ACRS. Tax Reform Act of 1986 then established the Modified Accelerated Cost Recovery System, called MACRS, for all property that has been put into service after December 31st, 1986. So MACRS and ACRS are tax depreciation methods. What it does is it provides you with a list of tables that give useful lives of various assets and depreciation rates. So it doesn't matter if you think that the vehicle that you just purchased is going to last you 15 years. Under MACRS, it tells you specifically how long to depreciate that specific vehicle. MACRS, again, like declining balance, does not care about residual value. Depreciation in the first year under MACRS is based on the assumption that the asset was purchased halfway through the year. Therefore, you only take a half a year's worth of depreciation instead of a full year. There are different classes of depreciation, and we'll look at the different classes. But classes 3, 5, 7, and 10 use a 200% declining balance method, whereas 15 and 20 use a 150 declining balance method, and classes 27.5 and 31.5 use straight line. It's not expected for you to know this or to calculate it, but to understand that you're taking straight line depreciation on the last two classes and then different depreciation on the other two. So here's the Modified ACRS Cost Recovery System table that lists your class period, class recovery period, or class life, and then the different types of assets that fall into the life. So a class 3, for example, are racehorses that are more than 2 years old, or any other horse other than a racehorse that's more than 12 years old at the time it's placed into service. You take a 3-year depreciation on those horses. 5-year, common examples of 5-year include automobiles, computer-based technological equipment, and manufacturing equipment. 7-year assets include fixtures, equipment, and furniture. 27.5-year assets are residential rental properties. So those houses that people own that they rent out at the beach or the lake or whatever, they take 27.5 years for depreciation. A non-residential real property is a 31.5-year life. Non-residential is in a building that's used for commercial purposes. This is what your table looks like. You take a look and you see exactly what recovery year you're in and what class your asset falls in. For example, with the 5-year class, in year 1, you would take 20% depreciation. Year 2, you take 32, and so forth. Notice that for a 5-year class, you take depreciation 6 years because in the first year, you're assumed to have bought it halfway throughout the year. So you have half-year depreciation in year 1 and half-year in year 6. And these are the percentages that you use for depreciation. So for example, using the same equipment cost of $2,500 for Ajax Company that we've been using all along, prepare a depreciation schedule under MACRS, assuming that the equipment is a 5-year class. Use the table 17.5. So we have a 5-year class asset with a cost of $2,500. For your depreciation schedule, you have the end of the year, cost, depreciation expense, accumulated depreciation, and book value at the end of the year. In year 1, our cost is $25. So our depreciation expense is 20% from the table of the cost, or $500. Accumulated depreciation is $500. Book value at the end of the year is $2,000. Cost minus accumulated depreciation. Year 2, our cost remains the same, but we go down to the table, and this time we take 32%. 32% of the $2,500 is $800. Accumulated depreciation is your $800 expense for the year, plus your $500 accumulated depreciation gives you $1,300. 25 minus 13 gives you 12. Follow this on down each year, taking the asset cost and multiplying it times the percent as listed in the table. You'll notice that in year 6, this would be what we take in year 6 as our percentage. When we take our depreciation expense, add it to our previous accumulated depreciation, we get accumulated depreciation of $2,500 with a cost of $2,500 minus accumulated depreciation of $2,500. For tax purposes, we do depreciate the asset down to 0. We don't worry about residual value with tax purposes. We depreciate it down to 0. Here's another example. If corporate headquarters for UPS in Atlanta is considering adding to its $96,000 fleet of delivery vans, what is year 5's depreciation expense using makers if one van costs $78,500? Again, extra information you don't need. The $96,000 the 96,000 vans they already have is irrelevant. Take a look and see. All right, our asset cost is $78,500, and the question is asking you, what is year 5's depreciation expense? So we take our cost of $78,500 and multiply it times the percent from the table for the recovery of year 5 down here to get excuse me, our depreciation expense for year 5 is $9,043.20.